Hello, Assalamu alaikum. This is Nafiz Al Tariq, and in this video I will describe about macroeconomic concepts, currency economics in the context of the currency crash of Turkish lira. So what happened to the Turkish lira in the 2021? The currency dropped its value by 44% in 2021. Before looking into that, let's revisit two important macroeconomic concepts. The number one, the relationship between the exchange rates and inflation rates, and the number two, the central bank's action to fight the inflation rates. So what happens to a country's currency when it experiences persistent increase in inflation rates? It devalues over time. According to relative version of purchasing power parity, a country's spot exchange rate will be completely determined by the inflation rate differentials between the two countries, which means the higher inflation country will experience currency depreciation compared to the low inflation countries. The ex-ante version of the relative purchasing power parity says that it is not the actual inflation rate, rather the expected inflation rate that drives the spot exchange rate compared to the other countries. So what empirical evidence shows? Evidence showed that in the 3 years preceding 100% increase in inflation rates, all countries saw their currency devalued by at least 80% against the US dollar. We have seen very high inflation rates and currency devaluation in the period of 1920s at Germany, in the 1980s, Brazil, Argentina, and the whole Latin America. In 2006 to 2008 and 2018 to 2020, Zimbabwe, 2017 to 2020, Venezuela, and in the 1980s and 1990s, Turkey. The second concept is what the central banks do, what macroeconomic tools they normally use when they face with increasing inflation rates. They normally tighten the monetary policy. They increase the interest rates to reduce the inflationary pressures. However, Turkey did the opposite. In November, Turkey has experienced inflation rates of 21%, and in the month of December 2021, they experienced 36% annual inflation rate, which is the highest in the 19-year period of the presidency of Recep Tayyip Erdogan. Rather than increasing the interest rate to fight the inflation, what Erdogan did? He decreased the interest rate from 19% to 14%. As a result, the deposit in lira becomes unattractive. So most of the Turks who kept their deposit in lira switched from lira deposit to US dollar deposit or euro deposits. As a result, the currency crashed. To fight the currency crash, Erdogan announced another peculiar announcement. He said if the Turks kept their deposits in lira for at least 3 months, they will be compensated by the treasury for any currency devaluation during that period. This means the taxpayers will bail out the depositors. Not only that, to fight the currency crisis, the central bank intervened in the currency market as well. In just 2 days, the central bank and the state banks bought $7 billion worth of Turkish lira from the currency market. The President Erdogan believes the weaker currency will help the economy, it will boost the export, and it will encourage foreign investors in the country. Not only that, he also believes by reducing interest rate, he can reduce the inflation rates, defying the orthodox economics rule. So let's see how the unorthodox policies adopted by Erdogan, whether they can benefit the Turkish economy or not. Thank you for watching the video. Stay safe. Take care. Thank you.